Right now, somewhere in America, a billionaire just made $10 million, and they paid zero in taxes. Not because they cheated, not because they broke the law, but because they are playing a completely different financial game. A game built on three words that the IRS cannot touch: buy, borrow, die. You are about to learn the most powerful wealth preservation strategy ever created by the American financial system. A strategy that Elon Musk, Jeff Bezos, and Warren Buffett have used to accumulate trillions, while ordinary investors hand 30% of their gains to the government every single year. Let us start with a number that should make you angry. In the United States, the capital gains tax rate for most investors sits between 15 and 20%. For high earners, it climbs to 23.8% when you add the net investment income tax. In high-tax states like California, the effective rate can exceed 33%. Now, here is the part nobody talks about. The system that created this tax was never designed to apply to the truly wealthy, because the truly wealthy do not sell. The poor earn income and get taxed. The wealthy build assets and borrow. That one difference is the entire gap between the middle class and generational wealth. In our previous video, we exposed how the bottom 50% of American households hold less than 3% of total national wealth. If you have not seen that video, the link is in the description. Because what we are about to reveal is exactly why that statistic exists, and why it never changes. The capital gains tax only triggers when you sell an asset. This is a critical legal distinction that the wealthy discovered and weaponized decades ago. If you buy Apple stock for $50,000 and it grows to $500,000, you owe zero tax. Until you sell, the IRS has no legal claim on unrealized gains. This is the foundation of the entire strategy. The strategy has three phases. Each one is more powerful than the last. Phase 1 is buy, not just buying anything. Buying appreciating assets, stocks, real estate, private equity, assets that grow in value over time, without triggering a taxable event. Warren Buffett has held Coca-Cola shares since 1988. That position is worth over $25 billion today. He has never sold a single share for lifestyle spending, because the moment he sells, the IRS arrives. So what does he do when he needs cash? He moves to phase 2. Phase 2 is borrow. Here is the insight that changes everything. Watch this carefully, because this is the single mechanism that separates billionaires from every other investor on the planet. The IRS does not classify loans as income. Read that again. A loan is not taxable income. When a billionaire needs $10 million to fund their lifestyle, they do not sell assets. They walk into a bank, pledge their investment portfolio as collateral, and receive a loan at 3 to 5% interest. The billionaire lives on that borrowed money, tax-free. Meanwhile, their assets remain in the market, continuing to compound, potentially growing at 10 to 15% annually. Their assets are outpacing the interest on their loan. They are making money while borrowing money. And the IRS has not collected a single dollar. This instrument has a name. It is called a securities-backed line of credit, a portfolio line of credit, PAL for short, JP Morgan, Goldman Sachs, Morgan Stanley. They have entire private divisions dedicated exclusively to providing this instrument to clients who understand that deploying capital permanently beats spending capital. In 2021, ProPublica obtained leaked IRS data, revealing something extraordinary. Between 2014 and 2018, Elon Musk paid zero in federal income tax. Jeff Bezos paid zero in 2007 and 2011. Their compensation came not from salary, but from asset appreciation they never triggered. Their lifestyle was funded entirely by loans against those assets. This is not a loophole. This is architecture, built into the tax code, available, in theory, to anyone with appreciating assets and the knowledge to use them. A salary makes you an employee of the tax system. An asset portfolio makes you its adversary. Phase 3 is die. This is where the strategy becomes, in the most clinical financial sense, extraordinary. When a billionaire passes away, their estate transfers to their heirs. And at the moment of transfer, something remarkable happens inside the IRS tax code, something called a stepped-up basis. Under IRS Code Section 1014, When heirs inherit an asset, the cost basis of that asset is reset to its current market value at the date of death. Here is the exact math. An investor buys Apple stock for $1 million in 1990. Today, that position is worth $200 million. Unrealized capital gain, $199 million. Capital gains tax owed if sold today, approximately $40 million. The investor never sells. They borrow against the portfolio throughout their life. When they die, their heirs inherit the stock. Their cost basis is immediately reset to $200 million. The current market value at death, the $199 million gain, erased, the $40 million tax bill, gone, permanently, forever. The loan against the portfolio? The estate sells enough stock at the new stepped-up basis to repay it, still paying zero capital gains tax, because the basis was just reset at death. This is why Forbes called the buy, borrow, die strategy, quote, the most powerful tax avoidance mechanism in the American tax code. It is entirely legal. It has been used by every major American financial dynasty for the last 50 years. And until now, almost nobody outside institutional finance understood exactly how it worked. Now here is where Stratovest AI enters the conversation. Until very recently, accessing this strategy required a private banker at JP Morgan or Goldman Sachs. It required a minimum portfolio of $5 to $10 million just to qualify for a securities-backed line of credit. It required estate attorneys and CPAs charging thousands of dollars per hour. The information asymmetry was total. In our previous video on the 5 AI tools hedge funds use, we showed you how institutional-grade intelligence is now within reach of individual investors. That video is linked in the description, because what we covered there directly applies to executing phase 2 of this strategy. Artificial intelligence has done something unprecedented. It has made institutional-grade financial modeling accessible to the individual investor. For the first time in history, AI-powered platforms can now identify which assets in your portfolio carry the highest unrealized gain and the highest collateral potential. AI-driven tax optimization tools can simulate the exact buy, borrow, die mathematics for your specific financial situation. Robo-advisory platforms are beginning to offer margin lending structures that mirror the securities-backed lines of credit once exclusive to the ultra-wealthy. The gap is closing. Not because the tax code changed, but because the tools to exploit it are now available to anyone willing to seek them out. For decades, the wealthy had both the strategy and the tools. Now you have the strategy. Stratovest AI exists to give you the tools. Now let us bring this to ground level. You do not need $200 million to begin thinking like a buy, borrow, die investor. You need 3 behavioral shifts. Shift 1. Stop treating your investment portfolio as a savings account. Every time you sell, you reset the compounding clock and trigger a taxable event. The single most powerful financial habit you can build is the discipline to hold appreciating assets through market cycles. Shift 2. Understand the difference between a consumption loan and a collateral loan. A consumption loan, credit card debt, personal loans for lifestyle spending, is financial destruction. A collateral loan against an appreciating asset, used to access liquidity without selling, is the mechanism the wealthy use to live well while their wealth compounds untouched. Shift 3. Begin thinking in generations. The stepped-up basis at death is the most powerful wealth transfer mechanism in the American tax code. It is not morbid to plan for it. It is intelligent. The wealthy think about legacy wealth at every stage of their financial lives, not just at the end. This is not a strategy for some distant future version of yourself. This is a framework for how you think about every financial decision you make beginning today. The buy, borrow, die strategy did not create billionaires. The tax code created it. The financial system embedded it. And the information asymmetry maintained it. For decades. As the exclusive intellectual property of the ultra-wealthy, that exclusivity is ending. You are watching Stratovest AI, which means you already understand that the future of individual wealth management belongs to those who combine institutional-grade knowledge with cutting-edge artificial intelligence. Subscribe, because every video, we bring you the intelligence the financial system was designed to keep from you. The next time someone tells you the system is rigged, you now know they are correct. The difference is, now you know exactly how it is rigged, and more importantly, how to use it. That is not a disadvantage. That is a weapon.